This is a video of the items that I was not able to cover in chapter 26 of your workbook. Now, I probably have also repeated some items that we did cover, but it'll be good review. So let's go ahead and take a look at, in this case, problem 26.1. And in this particular problem, you are being asked to compute the payback period and explain your computation. It says the company invests $50,000 in plan assets, and those plan assets have an estimated 10-year useful life. They have no salvage value at the end of their useful life. These particular assets that we're going to invest in will contribute $10,000 of annual net income. Now remember, I'm saying annual net income, so that means accounting income. And it'll contribute $10,000 of annual net income when depreciation is computed on a straight line basis. So that implies that depreciation is part of the net income calculation at $10,000. So we're asked to compute the payback period. Now remember, the payback period is computed on a cash basis. Therefore, we're going to have to remove the non-cash component that is also used to compute annual net income. And we do know that depreciation is part of the annual net income. And again, that's the accounting income. So what we're going to do now is we're going to have to figure out what is the amount of depreciation that is used in computing that annual accounting net income. So I am told that the plan assets that we're investing in are $50,000. They're going to have a 10-year useful life. So I take my $50,000 cost to those assets at investment, I divide it by the 10-year life, and that means my depreciation is going to be $5,000 a year. So I know I have annual accounting net income of $10,000. So in order to get back to my cash flow, I have to add back the depreciation, which is counted as an expense against my accounting net income, but is not actually a cash flow. So I'm going to add back that $5,000. So what that means is I take the $10,000 of net accounting income and I add back my non-cash expenses, which means I now have a net cash flow equal to $15,000. Now it's a matter of plugging in the numbers into the payback computation. So now I start out with my investment, which is $50,000. I divide that by my yearly or my annual cash flow, which I've computed now to be $15,000. So the answer is, when I do this calculation, the answer is 3.3 years. Okay, now let's go on to the next slide. And this is BE, right out of the book, BE 26.2. And we have two separate investments, and we're going to assume they're mutually exclusive. In other words, if we select one, we can't select the other. And we're given some information here. We're given the costs of the investment, the estimated salvage value of each investment, and the average estimated net income. Again, that's accounting income that is derived from each of the investments. And here we're being asked to calculate the return on average investment for both proposals. So this is a capital budgeting method called return on investment, or ROI. Now the first thing we do is we take a look at proposal A, and we insert in the equation the average estimated net income. And here we're told the average estimated net income, and again, that's accounting income. Remember, in terms of ROI, we use accounting income. We do not use cash flow. We use accounting income. So this is the amount that we use, the 15,000. That amount then is going to be divided by the average investment, which is the cost of our investment of $50,000 plus our estimated salvage value of $8,000, and that quantity divided by 2. And when we do that, the return on investment for proposal A comes out to 51.7%. Okay, now let's take a look at investment B. Okay, the average estimated net income, again, accounting income for investment B is $17,500, so we include that as a numerator. The denominator is our average investment, so it's going to be the cost of our investment of $70,500 plus our $6,000 estimated salvage value, that of course divided by 2. So in that particular case, the return on investment is going to come out to 45.8%. Now, of the two investments, which is the one that you would pick? And in this case, you would pick the one that gives you the highest return on investments, which would be proposal A, in the amount of 51.7% over the 45.8% for proposal B. Okay, now let's look at this particular exercise, BE 26.4 out of the book, and this is in a present value calculation. It says Landry's Tool Supply Corporation is considering purchasing a machine that's going to cost us $80,000. It's going to produce us annual cash flows, okay, cash flows. If we want to remember that we will, when we have present value analysis, we're going to base that upon cash flows. So it will produce annual cash flows of $22,000 over a 5-year period. At the end of the 5 years, the machine can be sold for salvage for $2,000. So the question here is, what is the net present value of the proposed investment? We're also told that Landry's requires a 12% return on all of its capital investments. So now the first thing we need to do is we need to compute the net present value, the annual stream, in other words, the cash flow every year for 5 years. So the annual stream of incremental net cash flows over 5 years at a discount rate of 12%. So we select, again, we mentioned these are annual payments, and we see that here, year 1, 2, 3, 4, and 5. There's 5 annual payments. So when we take a look at the table we're going to use the annuity table, which is basically saying annual payments. So in this particular case, we're going to go and cite the line at 12% for 5 years. In this case, the discount rate comes out to 3.605. Okay, we're told our annual cash flows are going to be $22,000 over the 5 years. Our discount factor is 3.605. And when we multiply the $22,000 times the 3.605, we end up with net present value of our annual cash flows of $79,310. Now that refers to our annual cash flows. We still have to value the one-time cash flow that will be coming at the end of year 5, and that's going to be the $2,000 cash flow. We sold that we'd sold the equipment or the machine at its salvage value of $2,000, so we have to value this. So in this case, we want to compute the net present value of a one-time receipt, not annual, but one-time receipt of cash from the salvage sale in the year 5 at the discount rate of 12%. Now let's go on to the next slide and continue the problem. Okay, if we take a look at, we're going to now look at a table, and the table is called the present value of $1. In other words, it's saying, what is the present value of $1, or in effect, one payment in the future, given a certain interest rate and given the number of periods. And in this case, we're going to use a 12% discount rate over 5 periods. So that number will be, that discount factor will be 0.567. So now we take the $2,000 cash we're going to receive in year number 5, multiply that times our discount factor, 0.567, and that's going to come out to $1,134. Now we know the present value of our annual payments over 5 years is $79,310, and that came from our computation on the previous slide. Now we enter in the present value of the single cash payment in year 5, which you see right here. And when we add these two cash flows together, the present values of these two cash flows together, we come up to $80,444. So now we have the information to make our decision with. And which alternative should we accept? And what we want to do is we want to select the alternative with the highest present value. So if we make the $80,000 investment, it's going to result in a present value of cash flows at 12% over 5 years equal to $80,444. If we decide to keep the money and use it for other investments, in other words, the money will be equal today what it is, the value of what it is today, that'll be $80,000. So we take a look, and that's going to the value, and that's going to be $80,000. So we take a look and we find that the present value of the $80,000 investment would be worth in today's dollars $80,444, which is higher than the present value of simply keeping the money and not making the investment. Now, another way we can express this is we take the $80,444 and we subtract out the present value or the value of the investment we're making and at the first part of year 1, which is $80,000. So we can compute the net present value of the investment to be $444. As long as the net present value of the investment is positive, it exceeds our threshold of 12%. Okay, now let's take a look at the next item here. And again, this is a problem where it's asking us about what is a payback period. Remember, payback period utilizes cash flow. Okay, a company's trying to decide whether to go ahead with an investment opportunity that's going to cost $55,000. We expect our cash inflows over the life of that investment to be $86,000 on an annual basis, while the expected outflows are going to be $72,500. And I'm sorry, that's not annual basis. That's total cash flows of $86,000 versus expected incremental cash outflows of $72,500. So in this case, all we need to do is we need to net the inflows against the outflows to see what our net incremental cash inflow is. So we're going to take our $86,000 of cash inflows in the year, our $72,500 worth of cash outflows during the year, which means our net incremental cash inflow every year will be $13,500. Now we take that amount, the $13,500, and we divide that into our investment of $55,000. And with that, then we get a payback period. In this case, our payback period would be 4.1 years. What that means is we would receive our entire investment back in 4.1 years. Okay, now let's take a look at another computation. And again, this is going to be a computation where I deal with two separate proposals, and we're going to do an evaluation of each of these proposals on the payback method, then we will do it on the return on investment method, and then the present value method. So let's take a look at the proposal analysis for payback. Okay, the first thing is we're shown that we have several different, certain different elements of information here for proposal 1 and proposal 2. And this could be information that was accumulated by our, let's say, cost accounting or management accounting department, different information about both of these proposals. So you doing the analysis will be challenged by what are the items that are pertinent to the payback period analysis. We have required investment in equipment, and we're going to obviously need that as part of our calculation. So we need to remember we're going to need that required investment in equipment. Estimated service life of the equipment, in this case it's 10 years for proposal 1 and 2, and we're not going to really have to use that. That will not be pertinent information. The estimated salvage value of $10,000 and $30,000 respectively for proposal 1 and proposal 2, since we're talking about simply net incremental cash inflows versus our total investments, we do not need the estimated salvage value. Now in this case, we have a line called estimated annual cost savings. What that means is we're able to reduce our expenses, and therefore, if we can reduce our expenses, we can increase our net cash flow. So this is the same thing as saying an increase in net cash flow. In this case, it's $90,000 and $72,000 respectively. Now that represents the incremental increase in our net cash flow as a result of these expense reductions. So this is the estimated incremental cash flow that we're going to be looking for in our computations. There's depreciation on equipment, which again, that is not necessary when we're looking at a cash flow basis when we already have the cash flow information. And also the estimated increase in annual net income. This isn't necessary because we're not performing an analysis based upon annual net income. That's accounting income. We're doing it based upon estimated an incremental increase in net cash flow. So now we have all the information we're going to need, and we start off with the investment on for proposal 1. I'm sorry, before we do that, okay, what we're going to do is we're going to insert the amount of incremental increase in our cash flow because we were able to reduce our expenses by $90,000. So we put that in the denominator box. Okay, now under investment, we're going to put the $500,000 from proposal 1. So now the investment is $500,000 divided by our annual cash flow of $90,000, which means then our payback period is 5.6 years. So at the end of 5.6 years, we'll have recovered our entire investment. And again, remember the payback analysis uses net cash flows. Therefore, we would use estimated annual cost savings, which would be an increase in our net cash flow. Okay, now let's go on to proposal number 2. In proposal number 2, the incremental cash flow is going to be $77,000, and the investment for proposal 2 will be $450,000. So it's going to be $450,000 divided by the $77,000. So that computes to a payback period of 5.8 years. So again, if we have to pick one investment out of the two, in this case, we would pick proposal number 1 because we receive our investment back faster than proposal 2. In proposal 1, we receive our investment back in 5.6 years. Proposal 2, we will receive our entire investment back in 5.8 years. Okay, let's look at this same data now and utilize return on investment. Now let's go on and perform an analysis utilizing the same data from the previous slide. In this case, we're going to analyze these two proposals based upon return on investment. Now we have all the same information from our previous slide. And it says here, for each proposal, compute the return on average investment, the ROI capital budgeting analysis. So what we want to remember in this case is that, first of all, when we are going to evaluate uh, the ROI, we're going to do it based upon incremental changes, or in effect an incremental increase in annual accounting net income. That's very important, not cash flow. We're going to measure the incremental increase in annual accounting net income. Now again, return on investment uses net accounting income, as I just said, for the analysis. Therefore, we're going to use the estimated increase in annual net income, or annual net accounting income, and that's a result from the cost savings that occurred. And we can see here estimated increase in annual net income. So we're going to be using the 52,000 for proposal 1 and the 48,000 annual increase in income for proposal number 2. So there I've just circled the estimated increase in annual net income. Okay, now we're going to take the average incremental accounting net income for proposal 1, which will be $52,000. We're going to divide it by the average investment for accounting for proposal 1, which will be based upon $500,000 plus our $10,000 salvage value, that quantity divided by 2. When we do that, our return on investment will come out to 20.4%. So we would earn 20.4% average return on investment on the average investment. Okay, now we're going to do this for proposal 2. We're going to use the same classification of data. So again, the estimated increase in annual net income here is $48,000. So we're going to place that as the numerator. Then the denominator is going to be, we're going to have the $450,000 investment and the $30,000 salvage value. So we see the $450,000 investment plus the $30,000 salvage value, that amount divided by 2. And when we do the entire calculation, it comes out to an even 20%. So in this case, under the payback method, if we have the choice between two separate proposals, we would pick the proposal with the highest return on investment. And in this case, it's 20.4% would be proposal 1, and which is higher than proposal 2, which is 20%. Okay, now let's try the same data, but now we're going to use this regarding with present value analysis, and exactly the same data at the top. So it says up here, for each proposal, compute the net present value, and we're going to use the rate of return, or the discount rate, of 10%. Now remember, net present value analysis is based upon cash inflows and cash outflows. So what we're going to be looking at is up here the estimated, basically the estimated annual cost savings. In other words, our increase in cash flows due to our cost savings. So we're using the same data as we used in our payback analysis in this case. Also, we do know that these are annual cash flows, and they're going to be occurring over 10 years. So when we're looking at annual cash flows, in other words, there's going to be a cash flow payment every year, we would look up that item or that amount. In order to calculate the present value, we'd need to use the present value of an annuity, over a certain amount of years. So we're going to use the annuity table. I've also, since the discount rates are hidden here at the top due to my clerical error, I put the 10% that is required, discounted amount. I put the 10% over the over the appropriate column. And I have year number 10 here. I've abbreviated the table so we can save some space. But you can see the discount factor here comes out to 6.145. So in this case, we're going to take the incremental annual net cash inflow from our cost savings, which is going to be the $90,000 from proposal 1. We're going to multiply it times our discount rate, which is 6.145, and that comes out to $553,050. Okay, but that doesn't tell the whole story, because we also have a one-time payment at the end of the life of the investment, and this is going to be basically the salvage value, what we're going to sell it for. And for proposal number 1, at the end of 10 years, we're going to be able to sell the investment, whatever equipment is associated with that investment, for $10,000. And there's a mark right there to estimated salvage value, $10,000. So in this case now, it's a single payment, a one-time payment. So we're going to use a present value of $1 due in some period, in this case in a future period. So again, we're using the discount rate of 10%. So we use the 10% column over 10 years. We look at the 10-year row, and the discount rate is 0.463. So now we take the estimated salvage value payment in year 10 of $10,000, and we multiply that times our discount rate factor of 0.463, and that comes out to a present value of $4,630. So if we do the summary of proposal 1, if we add the present value of our annual payments and our one-time payment together, we get this. We get $553,050 from our annual payments, plus we have $4,630 from our one-time payment. So the present value for proposal 1 comes out to $557,680. Okay, so that is the proposal. That is a present value analysis for proposal 1. Now we've got to perform the same analysis on proposal 2. And I haven't reproduced the numbers at the top, the columnar numbers for proposal 1 or proposal 2, because we've already seen them before. So we're just going to plug in the numbers. Again, we're looking for the annual cash flows over the life of proposal number 2. And those happen to be $77,000 per year. We're going to use the annuity table because they're annual cash flows. The discount rate is 10% for 10 years. So we end up with the discount rate of 6.145. The discount factor is 6.145 times our 77,000. So the net present value of our annual cash inflow from our cost savings is equal to $473,165. Now we need to determine the present value on proposal 2 from our one-time salvage value payment at the end of year 10. So again, we're going to use a present value of $1, a single payment due in a single year. We're going to discount it at 10%, and it's going to be for 10 years, so the discount rate is 0.463. So we take our $30,000 sales price, and that comes off of the previous slide for the salvage value, times our discount rate factor of 0.463, and that's going to equal $13,890. So from that, I take the present value of my annual payments and the present value of my one-time payment, and I can plug that number in to proposal 2. $473,165, the present value of the one-time payment in year 10, $13,800 equals, or $890 equals a total present value of $487,155. Now what I can do is I can take the information from my various proposals here, the $557,680 from proposal 1 and the 487,000, well, sorry, but before I do that, I take the $557,680 and I compare it to the amount that I would have needed to generate that cash flow. In other words, my net initial investment of $500,000. So I take the $557,680, subtract out the investment, which is $500,000. So the net present value of the investment for proposal 1 is $57,680. I'm going to do the same thing for proposal number 2. The present value of my cash inflows for my investment are $487,000. I will have to make an investment of $450,000 in order to generate those cash flows of $487,000. So the net present value of my investment for proposal number 2 is $37,155. So in this case, on my analysis of proposal 1 versus proposal 2, being that I can only accept one of the two proposals, I would select proposal 1 because it gives me a greater net present value compared to my investment over the life of the investment. Okay, now what we're going to do in this last slide here is summarize all three investment analysis techniques and see how they compare. Okay, here we have proposal 1 and proposal 2 again, and I'm going to put the data in here regarding the different proposals. We're going to compare them. Capital budget method, payback method. Under proposal 1, it was the proposal 1, the payback was 5.6 years. In proposal 2, the payback was 5.8 years. So in theory, we'd probably pick proposal 1 over proposal 2 because we get our payback quicker. Return on investment. Proposal 1 was 20.4% and proposal 2 was 20%. Again, for proposal 1, where we'd probably pick proposal 1 because its return on investment is a bit higher than proposal 2. Now when we take a look at net present value, the net present value of proposal number 1 is $57,680, which is the present value of our cash inflows minus the amount of our investment outflows at the first day of the first year of the investment, be $57,680. That's compared to proposal 2, which is the net present value is $37,155. So we'd most likely pick proposal 1 over proposal 2 because it provides a higher net present value based upon the cash flow invested in day 1, year 1. So with that, we would see basically that in this case, under these circumstances, the criteria here, we would pick, using payback, again, we would pick proposal 1. Using return on investment, we would also pick proposal 1, and using net present value, we would also pick proposal 1. Now, this doesn't necessarily have to be this way, depending upon how the computations, cash flows are, and so forth. These proposals can give you different answers in terms of which proposal is more desirable than the other based upon the capital budget evaluation method. And with that, that's the end of our presentation.